Well, hello, friends of Mirrors. Chad Parmeter here with Kyle Temple. Happy summer. Happy Mirrors Mid-Year Update 2025. We're planning on doing these every 6 months as sort of a cadence. We may do some when we have extraordinary events from time to time, but this is going to be our plan going forward, trying to hit high marks from each 6 month period of time with regard to economics and planning and that sort of thing. We really appreciate you taking your time out of your probably beautiful summer day, we hope, to join us today. And as part of this, I'm going to be real quick on my thoughts here. We're going to start. Kyle's going to start us out with talking about some ideas with regard to the financial markets and just some market updates and perspective that from our friends at JP Morgan. We've got some really nice slides to share with you today. And we also, I just want to make note of, we do pay attention to four primary firms here at Mirrors Planning to give us kind of unique guidance and thoughts as far as what we're doing in terms of planning and investing and all those types of things. JP Morgan being one of them, American Funds and Capital Group being another, our friends at City National Rockdale, and then finally Ladenburg Thalmann Asset Management. Those are our primary four firms. We like to get different perspectives because they are unique, and it kind of helps blend our thinking here at Mirrors Planning. Then after we get through some of the slides about JP Morgan, I'm going to talk about the One Big Beautiful Bill Act, OBBBA, along with some other matters that are going on around here at Mirrors Planning, just to kind of give you a heads up on. And our plan is to be done by about 10:40. We might even be done by 10:30 if I stop talking. And the one piece that I would say is if you do have a question or a comment or thought, you can, at the very bottom of your screen, you're going to see a little chat box that actually says chat on it. If you click on there, it's going to open up a screen to your right-hand side, and you can go in there and type anything you'd like. So if there's something that comes up from our conversation you'd like to have us comment on or visit about, or frankly, if something comes up from the conversation that you don't want to talk about on this call, but you'd like to visit with us on it, please go ahead and do so. But as we're going along, feel free to jump in there, and we'll try to answer anything we can while we're talking. So I'm going to be quiet. Kyle Temple, take it over. It's all yours.
Thank you, Chad, and thank you everyone for joining us today on a beautiful Tuesday in the summer. We start every year with our actually end of the year reviews, basically saying we're not going to make any predictions outside the predictions that we are going to be surprised. And of course, 2025 has already brought lots of surprises in financial markets. This is a slide that most of you should be pretty familiar with. We use it in a lot of our materials here at Mirrors Planning. But to look at the S&P 500, this is the most common benchmark for the US stock market index. And this is a year-by-year look over the last few decades, but we'll just start on the right-hand side, which is year-to-date 2025. Again, these gray bars represent where the stock market ends after a calendar year or 6 months through the year in the case of 2025. And we're up actually 5% already to start the year, which is a nice, modest return when you look historically at the type of returns we're getting out of the stock market. But the big surprise was some of the downside volatility we experienced. And that's what these red dots represent. They represent peak to trough declines in the stock market. And we started 2025 with a pretty severe sell-off, almost down 19%. That took place about mid-April is when the market bottomed out, and we've actually seen kind of a really strong snapback. We've recovered that entire 19% loss and are actually about 6 to 7% positive year to date through today. So this just goes through the end of June, but it's been a pretty good start to the stock market despite some of that initial volatility. But again, that volatility is natural within the stock market as these red dots represent. Things get really hot and things can get really cold in a quick fashion. And that's what we saw with some of the tariff kind of threats or negotiations, if you will, looked really severe in April, and they've kind of tapered back some of that talk, which again, we'll talk a little later in the slide. But this is also on the back of two really strong years. 2023, 2024 provided strong double-digit returns with fairly low volatility. And then again, we had the 22 sell-off where the market was down 25% at one point. We had the coronavirus pandemic where the market was down 34%. So this is again, really the idea of the red bucket, high volatility investment strategy. So this is just one sliver of client portfolios. Most of our clients are not experiencing kind of the full ups and downs of this, as we are big fans of diversification. But this is the stock market benchmark you're going to see most often in the news. And so we like to show kind of where things lie so far year to date. And so our thought is, just because we've recovered from the downside volatility doesn't guarantee that we can't, get back later this year. So not making any promises on a strong year like we have in the last 2 years. We'll kind of wait and see what takes place in the rest of the year. On the flip side, fixed income bonds continue to be quite appealing for the more conservative oriented investors. These are, again, our kind of green bucket assets, if you're familiar with our lingo there. This takes a look at different fixed income asset classes. So US Treasuries, those are US government bonds, municipals or state and local bonds, investment grade corporate bonds here in the US. And the gray bar represents a 15-year range of yields that investors have gotten over the last 15 years. The purple bars represent the actual 15-year median. So we've been in a fairly low interest rate environment over the last 15 years. But these blue diamonds represent where we are at today in yield. So right now we're getting over 4% in US Treasuries, very, very high quality investment grade assets, little volatility typically in those types of things. So if we're able to go get 4 or say 5% in investment grade corporate bonds, that's a really good place for a conservative oriented investor to be, considering the low yields that we have gotten historically over the last 10 to 20 years out of these types of products. So don't need to take a ton of stock market risk to get actually some pretty healthy returns. We don't ever shoot for large returns in our financial planning projections. Most of our return assumptions are in the 5 or 6% range. So if we can get that kind of return out of investment grade bonds, for example, makes it a pretty good place to be for a retiree who just needs some income in retirement. Interest rates ultimately do go hand in hand with what the Federal Reserve is doing in regards to its benchmark interest rate. This is another long-term view of the Federal Reserve's interest rate policy. You're going to see this is the coronavirus pandemic where they brought interest rates to essentially zero. And then 2022, we had that big inflation spike. And the result was the Federal Reserve having the largest interest rate spike in recorded history. We got up to over 5%, almost 5.5% in the Fed benchmark interest rate. They have done some cuts over the last 12 months, which this represents here. So we're at about 4.38% today. The blue diamonds here represent where the Fed and their estimates thinks will be over the next 12 to 24 months. So they are anticipating cutting rates. Right now, we've been in a wait and see period over the last few months as they look to gather more data and seeing kind of really what's going on with inflation, what's going on with tariffs. And then the green diamonds represent where financial markets expect the rates to be. And you're going to see they're expecting the rates to be a little lower than what the Federal Reserve currently projects. And then they ultimately long-term would like to kind of get into that 3% range. But as you can see, this is quite a volatile kind of ride here. And so for our conservative oriented fixed income investors, or if you have some excess cash sitting on the sidelines, we feel like it's a pretty good time to start locking in these yields, because you can go get, fixed income, as we just showed, in that 4 to 5% range. There's no guarantee that's going to be the case 12 to 24 months from now. So we like, healthy, good yields on cash, CDs, investment grade bonds. Good place to be. Inflation update. There was actually an inflation report that came out this morning. So we have an extra month of data that actually came in at 2.7% on an annualized return. So we have seen a little spike in inflation over the last couple, not a spike, but an increase over the last couple months. Still nothing coming close to what we experienced in 2021 and 22 with the big inflation spike. And what's cool about this chart is it shows what the different categories that are causing inflation. So in 2021, 2022, for example, everything was going up. Energy prices were going up a lot. Food, grocery store prices were up a lot. Core goods, that was the supply chain issues we were having with a lot of the ports shut down, made existing demand really high, lack of supply, push prices up. Dining and going out and doing things is a big contributor to inflation. And then shelter, which is rent or owning a home, is obviously a pretty material aspect of inflation. But the Federal Reserve would like to see us kind of in that closer to 2% range, which is where we were trending really nicely before the 2020 pandemic. But you're going to see we have made really good improvements in inflation over the last 12 to 24 months, just not quite low enough to where the Federal Reserve feels comfortable, because what they don't want to do is cut rates and then have inflation just kind of get out from under them again. So kind of a wait and see period, but continuing to make pretty good progress on the inflation front. The big question right now is core goods inflation going to come back with some of the tariff negotiations that are taking place? This is a really interesting slide again from the JP Morgan team, kind of estimating where we currently sit in regards to the tariff impact on the economy. This orange bar represents the initial Liberation Day tariff policies. You're going to see almost 30%. That would have been the highest essentially in record over the last 120 years of the US economy. That is why the stock market sold off to 20% really quickly. That was going to be a very large economic impact if we remained at those levels. There has been some kind of walk back of those rates and more negotiation, kind of hopefully kicking the can down the road on some of these higher rates. And right now, JP Morgan projects us, we're at about a 15% effective import rate on tariffs, or tariff rate on imports. That is still, as you're going to see, a highest level we've seen since before World War II. So we are in a pretty unique market environment. Economics are very complicated. There's a lot of moving parts, but this is a kind of new wrench kind of getting thrown into the economy. We will see how the consumer and businesses adjust, whether it comes through passing off costs to the consumer, which is likely going to be a pretty substantial portion of that. There also might be some demand softening as higher prices, people just aren't willing to pay those rates. So kind of in a wait and see period right now. This is unfortunately changing literally by the hour by the president's social media posts, essentially. So we'll see where we land here in another 12 or 24 months there. Federal finances, this has also been a really big part of the news lately as Congress goes and builds out a new budget. This is just a really quick look at where is the US government spending money. You're going to see right now we are spending 14% of our spending on just net interest. So that's paying back past debt that we've taken on. Social Security makes up 22% of that. Medicare and Medicaid make up another about 25%. We've got mandatory spending, the defense budget, and then some non-defense discretionary spending. Those all total $7 trillion is the projection for 2025. The issue is, unfortunately, we are not bringing enough money in the door to pay off all of these expenses. You're going to see income taxes, payroll taxes, corporate taxes, and then other. Those will be some of the tariff revenue, but we are by no means going to have enough tariff revenue or any tax revenue to come up with a $1.8 trillion shortfall, which again is going to be issuing more debt, which creates even more net interest expenses. And so this is kind of, if you're in Congress, this is a sticky place to be. Spending cuts aren't popular, tax increases aren't popular, and that's kind of why we are at where we're at today. This is a long-term look of how big of the deficit and compared to our economic output. And you're going to see right now about 5 to 6% has been the trend over the last few years. This was the coronavirus spike. So when all that stimulus went out to consumers and businesses, that was obviously a large federal expense. And then a very similar thing took place during the Great Financial Crisis. And at one point, shockingly enough, we were actually in a surplus for a few years in the late 90s. But that does not look to be in the cards in the preceding next couple decades. Again, the most recent OBBB is going to, by projections of JP Morgan, increase the deficit a little bit more than what the trend we were on before this bill got put into place. On the consumer side, however, things look much better. You're going to see the consumer balance sheet has about $190 trillion in assets. That goes into homes, bank deposit, pension funds, and other assets. So just stocks and bonds, essentially. That represents $190 trillion. And then we've only got about $20 trillion in consumer debt out in the market, and 2/3 of that is mortgage debt. You're gonna see we have some student loans, auto loans, revolving HELOC type loans as part of that mix as well. But this is a much healthier balance sheet than some of the numbers that we just looked at on the federal side of things. Another really important data point in terms of economic health is household debt service ratio. How much of someone's disposable income are they putting down towards debt payments? And we're at pretty healthy levels right now, under 12%. You're going to actually see right before the great financial crisis in 2007, almost 16% of people's disposable income was going down to pay down debts. That's when they had 2 mortgages. There was just too much debt in the system. And then that's when we had the great financial crisis. People got really underwater on their homes, and it was just kind of a downfall effect from there. Luckily, that did create a deleveraging process. So the US consumer just naturally took on less debt. And it was really actually quite an interesting phenomenon during the COVID pandemic. People weren't spending money because a lot of things were shut down. And then they were also getting the stimulus checks from the government. And people were just naturally paying down their debt loads. So we actually got really low levels here, and they're kind of trending back to probably that 12% range, which again is still quite healthy for an economy. And then this last bar just looks at delinquencies. So you're going to see again the great financial crisis, spike in mortgage delinquencies, credit cards, all types of debt. The interesting one here for some of our clients is the student loan aspect. So in 2021, federal government put all student loans on forbearance, given the circumstances in the economy, which made it essentially impossible to be delinquent. But that forbearance period actually just ended earlier this year. And so you're going to see there's a big spike in the student loan delinquency rate. But again, that's just kind of going back to normalized levels of where we were at pre-COVID pandemic. So just something to keep an eye on. But what this ultimately shows, the consumer is in quite a healthy shape right now, which is positive news for our economy. The dollar has been a big news item lately as well. The dollar is down about 11% so far year to date. Seems like a pretty big move, but as this graph shows here, the dollar is a lot of boom and bust cycles. So it is kind of interesting to watch to see where we end up here, but so far it's not anything that's super out of the ordinary in regards to historical economic performance there. And then this one here is just a view of our trade balance. So right now we have a pretty large trade deficit. I know that is some of the things that the tariffs were supposed to help, but right now we're not turning in the right direction in regards to that. So just something we'll keep an eye out and see if policy is actually making a positive impact on those goals. Earlier, we just briefly highlighted the US stock market, but the international stocks are actually off to an even better start than we are here domestically. And some of that does have to do with the declining dollar, which this graph from JP Morgan represents. We saw a very similar declining dollar in the 2000s, and that's what this gray bar represents. And when the purple is going down, that means international stocks aren't performing as well as the US stocks. And then what's going up, that means international stocks are performing better. So last time the dollar declined, really good for international stocks, not as good for US stocks. That trend reversed. US has definitely dominated over the last decade compared to international stocks. But so far year to date, that dollar is back in a declining, weakening period, and international stocks have gotten that tailwind and have now outperformed US stocks so far year to date. So just another interesting trend to to observe and another reason to stay kind of globally diversified and not throw all your eggs into one investment philosophy. Consumer sentiment is quite low right now, but what's really interesting about this chart, I'm not going to go through all these data points, is when the consumer sentiment is lower, that actually ends up being a better time to be a stock market investor in the S&P 500. These just note the low points of consumer sentiment and the next 12-month returns from the S&P 500. These are all pretty positive numbers, but if you look on the flip side, when the consumer is feeling really confident, that's actually kind of a reason to be a little cautious. You're going to see we got some negative numbers, flat, very, very modest to negative when consumers are feeling really good. Technically, when the consumer is feeling good, they're taking more risks. A lot of the good news has already been priced in, and then that's when you kind of see the ebbs and flows of economic growth there. And then our very last slide, kind of really what we're all about here is just stay diversified. It's really hard to kind of trip yourself up. We don't know what's going to excel this year compared to last year. As I mentioned earlier, it was a really strong year for the S&P 500 the last 2 years. But so far, year to date, developed markets, so international and emerging markets, are actually quite leading the way compared to the US stock market. But if you have a diversified mix of assets here, you're going to be feeling pretty good. You had a 7% return year to date. So stay diversified and focus on your buckets. Make sure you got some green, yellow, and red exposure. And we've been able to navigate some pretty difficult markets with that strategy, which is what we're all about here. So with that said, I'm going to pass you back to Chad.
Very good. Thank you, Kyle. That was great. I would just summarize a couple of the thoughts that Kyle shared. Super useful. We expect market volatility to not go away anytime soon and probably get a little bit greater this year. Really interesting opportunities in the fixed income market, as Kyle pointed out, much higher yields right now. And if interest rates do start to come down because the economy slows a little bit due to tariffs, higher inflation, whatever, well, higher inflation, they won't reduce interest rates, but let's say the economy starts slowing down, then you will actually get a benefit from interest rates coming down as an investor. So that's pretty interesting. This tariff thing is going to be really interesting. JP Morgan estimates about 60% of the cost of the tariffs is going to get passed on to us as consumers. So, and it's primarily going to be in goods. So buying a couch from China, sneakers from China, wherever they're coming from, outside the doors of the United States, we're going to just be paying attention to that. The thing that keeps us up at night in this office are the federal finances, not the consumer. The consumer's in good shape. Federally, though, if you do the math, I did the math while Kyle was talking, that $952 billion of interest payments that we're going to make this year, that equates to $2.6 billion a day that we are paying on interest. And it's not paying down the debt. It's just paying the interest on it. So it's like a credit card interest, a minimum payment. That's a problem. The dollar dropping really does make international investments and global investments interesting to us. And just remembering that consumer sentiment, when everybody's really excited about everything, that's probably a bad sign. When everybody feels really bad about stuff, that's probably a good sign as an investor. So just fun stuff to pay attention to. Well, we've got the One Big Beautiful Bill Act on our screen now, and I'll just chat in. I just threw in some things that I thought were sort of interesting. Most of this bill was really for the people on this call. I'm not going to go into what's going to happen for business owners and what's going to happen for a lot of other issues that they tackled here. It truly was a big bill, but for most of the folks on this call, it was to make the tax cuts that happened in 2017 permanent. So they weren't going to go up at the end of the year. So that was kind of first and foremost. They've increased the standard deduction a little bit through this bill, and it's going to continue to adjust with inflation. The salt tax deduction is a pretty big deal for those of you who itemize and who live in states that have state and local taxes that used to be kind of limited as to how much you could deduct. That's changed. Now that is limited based upon income. So all this stuff is not exactly a dollar for dollar thing, but that's a pretty interesting caveat. And then the federal estate tax per person is going up to 15 million by next year. It's currently at 13.99 million. So prior to 2017, it was at 5 million per person. Okay, so it's gone up and is going to continue to go up on the federal estate tax front. So if you have a married couple and you're worth $30 million, you can actually pass that on to heirs and not pay an estate tax. Essentially, what's going to happen by 2026, and that will continue to go up. Key takeaways, we're going to see lower tax rates for longer, higher standard deductions, and more opportunities to itemize. Utilizing those SALT deductions are important to think about. But I would just say this, everybody on the call, check in with your CPA, take a look at your current situation and this new tax structure and figure out, how is this going to kind of play out for me? Because it does go back to the beginning of this year. So a lot of this stuff is going to be playing out for your tax return for 2025. So there could be some opportunities and some planning to be thinking about. So just interesting to see. But it really speak with your CPA would be what I'd encourage you to do. All right, next. All right, we got a webinar coming out. We took the summer off from our webinar series. It's just we realized that maybe we can do our webinar, but having a subject matter expert, we're going to focus in on one in the early part of the fall, one later in the fall. Carl Richards, who's a New York Times bestselling author, and I was actually fortunate to be up at his house last month for a little retreat, has been willing to come on and talk about a new book that he is coming out with this fall, Your Money: Reimagining Wealth in Simple Sketches. You may have seen a lot of his sketches. This is an example of one of them in the New York Times. Over the years, he's written The Behavior Gap, the one-page financial plan. Very, very smart. Always has good thoughts and ideas in terms of people thinking about their money. And so we're excited to have him join us on September 9th at 1:30. We will, as always, record it. So if you can't make it, register. We will send it out. We also always keep these on our website, so people can always jump in there and take a look. We have some in-person workshops coming up. We tend to do these in the fall, winter, and spring. We've been doing our retirement abundance workshops over at the Heathman Hotel. We're going to be doing some more geared around taxes and retirement, estate planning, and we're going to introduce some women-only events that are going to be geared around kind of starting over after becoming widowed and/or divorced. That's an area where we spend a lot of time. As most of you know, these big life transitions are a fairly high part of our business here at Mirus, and we're doing more and more of these workshops for existing clients as well as prospective clients, just to kind of be educated about these types of items like we're talking about on this webinar today. We've been getting some nice support from our friends at Osaic. They have a foundation that they set up, I want to say it was 3 years ago now, to provide support for different charitable endeavors. Of course, most of you know that we have our Mirus Cares program that we do with regard to our Alzheimer's research. I think we've raised over $115,000 with your help over the last decade for Alzheimer's research, and we continue to do that. We'll touch on that in a minute. Kyle, you want to speak on the Pointer Foundation as well?
Yeah, I'm on the board of a small little nonprofit organization, and one thing that's really cool about the Osaic Foundation is they are very interested in getting dollars to grassroots organizations. And for anyone that's interested in learning more about how they go about this, they actually put together a fantastic newsletter. But the smaller organizations hard sometimes to raise money, so having a big foundation that can then help support some smaller organizations is really impactful for making sure money gets to smaller organizations that are in the community doing the work. So we're very thankful to have Osaic support both on the Mirus Care side and then also some of the personal stuff that we are doing away from Mirus as well.
And I would say that anybody who is a client of ours, because we have a good relationship with Osaic, they provide all of our back office support and everything else. And I'm the chair of the National Advisory Board with Osaic. If you have things that you'd like to have some support, some initiatives, some charities, please let us know, because there is money there to be used and is available. So just a heads up on that. Save the date. Anybody who wants to shuttle on down to the Seattle Center or walk in your neck of the woods, there are these Alzheimer's walks all over. But we are again going to be walking around Seattle Center. It's, what do you think, Kyle? Mile and a half walk. It's very easy. For people who want to join us, we'd love to see you. If you don't, that's okay too. We always appreciate the support and the walkers if it works. Uh, Starts at 9 a.m. You kind of hang out. There's a ceremony, and then we go for our little walk. So normally we're done by about noon, but it's always a good time. And in the fall, typically it's nice weather. So we'd love to see you. And I'd just like to say thanks to everybody who is always introducing us to nice people who you think we might be able to help. We continue to engage new clients, and we're most of the time it's because of moments where people are facing, emotional and complex situations, and they need guidance to make thoughtful and informed decisions about their unique situation. It's loss of a loved one, a divorce, sale of a business, retiring, or some sort of a job, a career change, where people are just really in need of direction and clarity and kind of a buildup of their sense of confidence in their planning. And our approach, the next slide here, hopefully kind of walks. We'll address that here in a minute, Chris. Thank you. Our typical approach, just so everybody knows, and I think some of you know this, but we really spend a lot of time when people do get introduced to us, and it's typically begun by a like-minded professional and or a happy client. We want to make sure our needs and their services and our services are congruent with what people need, our personalities, our expectations, they fit with one another, and we have an engagement. We have an engagement that's called phase one, where we're just planning and providing guidance. We're analyzing someone's situation, we're stress testing it, we're optimizing it, we're helping implement the strategy. That's all done we either charge hourly or based on a project-based kind of a structure. We are not setting up accounts, we are not selling products. When and if we get through that exercise with people as they're going through a divorce or they've lost a loved one or what have you, and they may or may not want us to be a long-term guide for them, they have a choice. They can say, hey, look, you just pointed us in the right direction. We're ready to go. We're going to do all this stuff on our own. We worked with somebody else, whatever. We have a lot of those situations where they might be working with another advisor, but they need somebody to kind of give objective advice. It's almost like concierge medicine to some extent. We're giving that kind of guidance, not selling anything, but just providing guidance. But some people will say, look, we'd like to have help with investment management. We'd like to have an ongoing guide or an ongoing co-pilot on our journey. Well, that's the ongoing wealth management piece, that phase two category. So when we're meeting with people, you can't even get to phase two, ongoing wealth management with us unless you go through kind of that planning process. That's just how we work. It gives us an opportunity to test drive the relationship. It gives clients the opportunity to test drive the relationship and see if we know what we're doing. Our guarantee, by the way, for phase one, let's say we estimate the cost of a planning engagement's $3,000 and we don't do a good job. It's never happened, but let's just say somebody says you didn't do a good enough job for us. Our guarantee is don't pay us. Don't pay us. If we don't deliver, you don't have to pay us. We don't charge and we don't collect until we're done and people are fully satisfied. They're always fully satisfied ultimately, but sometimes we go back and forth and we have to do a couple new iterations. That's totally fair. But that's our merest guarantee. And then we could potentially discuss a long-term relationship. So that's how we work. Question, what minimum funds do you prefer to take on new clients? So getting back to that slide that we just looked at, that phase one has nothing to do with any kind of minimum amount of funds. That does not even enter into the picture. If we get to the case of ongoing phase two proactive wealth management, we don't really have a minimum, but I would say where we're probably best is with somebody who probably has a $500,000 or more that we're going to be managing, or somebody who wants to pay us on an ongoing sort of quarterly retainer. it may not have to do with the investment management piece as much as just what we're doing in terms of the work that we're doing. Because a lot of times we're meeting quarterly and we're talking about investment real estate. It could be their business. It could be all sorts of other things that have nothing to do with actually managing portfolios. I had a question about Bitcoin as part of the recommendation mix. It is currently not part of our recommendation for clients to own Bitcoin. Could it be in the future? I never say never, but it has not been part of our, that would not be a red bucket asset. That would probably be like a purple plus bucket asset. We don't have that bucket in our mix at the moment. So, good question, but not part of our suggestions at this point. And Q&A. Well, I guess we're already getting some of the Q&As in there, the chats. Any other questions that anybody has, throw them in the chat box. And we'll just kind of hang out here. Kyle, did you have anything that you wanted to add to what I was just sharing there?
Oh, that was great.
Well, we'll stick around here for another minute or so, but we certainly appreciate everybody joining us today, and we hope this was useful. We're going to continue to do it, and we'll do something at the beginning of the year. Oh, what about medical debt as consumer debt?
Yeah, I've been in that calculation there.
It is part of the consumer debt.
Yep.
Yeah. Yeah.
In the
Does that
grand,
make sense? So medical debt is part of consumer debt. Yeah. Thank you, Michael. But we just really appreciate everybody joining us. I know it's a beautiful summer day, but we will plan on doing something at the beginning of January as well, to make sure that we touch on the entire year of 2025. And what we're also planning on doing is then projecting forward what our 2026 looks like, so that people can have a kind of a calendar of our events. And we just find like this is an easy way to be able to reach a lot of you. If there are things that came up from this conversation that you'd like to speak to us specifically as it relates to your situation, reach out to us, team@mirasplanning.com, team@mirasplanning.com, goes to all of us, and we'll look forward to hearing from you. But everybody have a great summer. As you know, we're taking Fridays off in the summertime, already enjoying it. And we appreciate all the feedback in our webinar chat too. Thank you all for everything. So we'll see you. We'll see you probably in the fall. Okay. Thanks again.
thanks everyone. Have a great summer.